Okay, hello everyone. This is Beyond the Greeks. So this is the weekly trading show that we're doing here at the Panoptic team. Today we do some back tests, but overall we just want to make it a bit easier for people to understand Panoptic, to understand options, to understand the best strategies overall. We're learning every day. Even us, we don't necessarily know what the outcomes is going to be for most of these studies, but overall we try to produce them consistently. If you have ideas yourself, you can also reach out. But nothing we say here is financial advice, of course, but it's just a way for people to get a better understanding of how we see options here at Panoptic. What we say can be applied to Panoptic, but also any options protocol. Here we're joined with Amy Khaldoon. How are you doing today, Amy?
Hello, everyone. Very well, thank you. How about you? How are you doing?
Yeah, very good, very good. I'm in a small little cubicle, I guess, co-working space cubicle. Hopefully it's not too echoey. But these are very nice, very, very soundproof. There's people, I guess, over there. I don't hear them.
Yeah,
And
I
you don't.
mean, that's great because my dog is, because I'm at my parents, so there's a dog downstairs just like making a lot of noises. So I hope it's not my earphones are not catching it.
Barking about
But
options, trying to also find the best trades. What type of
yeah,
dog is it?
good question. I have no idea.
Oh, no?
it's
Okay.
a mix between two types, but I don't know which one. I think there's golden retriever for sure, but there's another one which makes the dog even smaller, and I don't remember. So
Okay.
we have it because we actually, there's somebody who had few little dogs, and they wanted to like just give away to people they knew, and we were part of that of that list. And my little cousin, she fell
A
in
good
love.
trade or good
Yeah,
decision or
I mean, it wasn't even a trade; it was like a free trade.
oh,
So
there
yeah,
you
it's
go.
been with us for 7 years. So I guess maybe,
Test of time, definitely.
yeah.
It would have been gone earlier. Cool. So yeah, this is so today again, Amy has prepared some research. This is a lot of it. We try to do back testing. So this is the title of this live stream: back testing the best delta neutral strategy. So Amy has done some bearish trades, which is selling a call or buying a put. Some bullish trades, which is buying a call, selling a put. Again, we just go through the different ways to be bullish and bearish. Here, it's about delta neutrality. So when you have no idea or where the market's going to go, if it's going to go up or down, it's actually quite difficult to know. I personally trade delta neutral because I'm always wrong. So typically, there's a risk on both sides, but then that also means that you don't have committal to a specific direction. So that's kind of a lot of what we are saying with options. It can be neutral, it can be bullish, bearish. The field is up for grabs. You can do whatever trades you want. So here, in your case, we're going to compare two strategies, straddles versus strangles. But yes, take it away.
Yeah, exactly. So yeah, hey everyone. Hope you're all doing well and getting ready for some summer. So here today, I'm gonna walk you through our new backtests. So far, as Guillaume said, we've seen multiple backtests on simple bullish and bearish strategies like selling calls or shorting calls, etc. So today on our part three of backtesting pan options, we are adding a little bit of spice on that and increasing the level of strategy. But by increasing the level of strategy, I don't want to like scare anyone. I'll make sure that it's going to be a little bit fun. And obviously, if you have any questions, make sure to send them on either on all our platform or on social media. So yeah, we are backtesting what we call multi-leg strategies. And by multi-leg, we generally mean that we are involving simultaneously buying and selling multiple options contracts with either like different strikes or expirations or both. But here in our case, we don't have any expiration, which makes it even more interesting because our options are perpetual. So these multi-leg strategies are designed to profit from specific market conditions while managing risk and capital efficiency. And so yeah, as I said, we don't have any expiries. So being having perpetual options, they make even the trades more interesting profit-wise. And yeah, we can start now with some definitions. So what is a straddle? What is a strangle? Because these are two types of multi-leg strategies. And what's the difference between these two? So yeah, straddles are volatility-focused option strategies that involves buying both a call and put option at the same strike price, which is typically at the money. This creates a symmetric V shape, as we see a V shape payoff profile, where the strategy profits when the underlier moves significantly in either direction away from the current price. There is unlimited upside potential if the underlier price rises, the call leg is activated, and if there's a decrease in price, the put leg is activated. So there's a protection either way. The maximum loss is limited to the total premium that is paid for both options and occurs when the other lion remains near the starting price, as we can see. Making this
So
straddle
this
like,
looks like a good deal, right? It
yeah,
has a lots of bullishness and lots of bearishness. So why don't everyone trade this, you think?
yeah. Well, it depends on how much it is, right? So that's like the first thing that you need to see, like the premium, how much is gonna go to the person who's selling you these straddles or these strategies, this type of strategies in general. So yeah,
And maybe yeah, because the anything that you buy has to be sold by someone else. And yes, in TradFi, it's actually so efficient that the price you pay is actually
it's
like
exact.
almost like very small spread. It is what you get. At the money, it has a ton of liquidity,
Yeah,
and you can be pretty sure that if there were some inefficiencies, then someone would be capitalized on those at the tunes of hundreds of millions of dollars. So a lot of these are extremely well priced, and yes, the upside seems great, but then the cost you pay makes it so that unless there's a big move, you may be kind of a wash. But yes, it's all the beauty of options that it's so diverse that there's always a arbitrage trade that can exist,
yeah,
and there's so many of them that you can expect all of this to be very efficient.
yeah, exactly. I mean, in options, there's like a strategy for every type of trader, basically. So, which makes it even more. It's a very rich trading world, I would say. So yeah, here with straddles, they, as Guillaume said in the beginning, they're very much ideal for traders who are expecting high volatility, but they're kind of uncertain about the direction. And we can now move to strangles, the next slide. So here, strangles, on the other hand, they offer a more cost-effective approach to volatility trading by purchasing out of the money, so it's not at the money, out of the money call and put options at different strike prices, which create this um, wider, I would say, profit dead zone between the strikes. And as you can see, the strategy requires larger price movements to become profitable, since the underlier must even break beyond either like at the money range. And why do we need the strategy? Like, why can't we just stick with straddles? You would say, well, here, since we have this profit debt zone, um, we have a compensation. So the compensation is actually very simple, which is just lower cost compared to straddles. So if you want to, if there's like traders who are seeking volatility exposure with reduced capital commitment, but they want to accept the trade-off of needing like more substantial price movement to achieve some kind of profitability, then they buy strangles instead of buying straddles. So that's kind of the difference between those
And
two. So
you
yeah,
can be very wide too, or very narrow. I guess
yes,
the straddle is the limit of them being on top, but then the strangle has a range, right? So
yeah, exactly. So yeah, with the strangles, what's interesting about them is that since you pick how far of the money you want to place, like the leg, you actually control how wide your profit zone is. So if you want to, for example, bet on only extreme moves, you just go even deeper out the money, which is even cheaper. But it would just need like more movement.
so this is the Nassim Nicholas Taleb trade. So black swans, which is there's only one COVID maybe per decade or
Mm,
crash or dot-com bubble, and if you can
yeah,
time it right, you can make multiples, 10,000%. But then you won't see that payoff very often. But when it comes around, this is a good trade. So the width also has some probabilistic. If it's a very unlikely scenario, you'll pay almost nothing. But
yeah.
then if it's realizing stuff can be getting a lot of profits.
Yeah, exactly. Or even like right before like any big events, I don't know, like Fed meetings, earnings, or like major crypto upgrades. or anything like that, like straddles or strangles, they tend to like their prices, they tend to balloon. And because it's just like at the end of the day, it's just like a pure bet on expected volatility. So for example, for before a Fed meeting, so like I don't know if there's a president is gonna get elected, you just don't know after that if the price is gonna go down or if it's gonna crash. You just buy these straddles or strangles and you're set for life
Yeah,
basically.
yeah. I mean, it depends. The I'm typically on the sell side, and I sometimes trade earnings for different online earnings straddles. Also, I am very wide. I profit. I mean, I benefit from that heightened volatility, so I get paid more as a seller because people want to buy. But it's so much of a crapshoot because sometimes they do move quite heavily, and then Nvidia for a while was like every time going higher and higher, and then the straddles and our strangle buyers were doing very well.
Hmm.
Other times there's no huge move or a tiny bit. You're still within the range and you don't make money. You just lose the premium you pay. So that's kind of the balancing act here.
Yeah. Yeah. So yeah, I mean, at the end of the day, both straddles and strangles are delta neutral at initiation, so they don't care which way the market moves, only that it moves, basically. So it's very much perfect for indecisive traders who have an actual conviction in volatility. And yeah, so now let's move to our back test, some data, some results. So here for our backtest, we are using a typical pool, which is the USDC E30 BPS pool. From here, it's from May 24 to April 2025. So it's a 1-year backtest. We are using 50 delta monthly options for the straddles and 30 delta monthly option for the strangles. So it's at the money for the first and out of the money for the second. In the backtest, we evaluate both weekly and monthly rolling frequencies. And here, the weekly resets, they just help us like stay closer to the current market moves. While monthly resets, they help us capture like bigger price swings over longer periods. Basically, just like what we've done in our previous backtest. And so, yeah, looking at the ETH price chart, sorry, if you need to come back. So here I chose this one because it's like the kind of price action that is exactly what we want when testing straddles or strangles. So we have like this choppy low volatility periods where straddles maybe they would be perfect to collect some premium, some to collect some returns. And also we have these big breakout moves, especially like the massive ones in the beginning of 2025. So here we are expecting the put leg to be activated. So yeah, I just wanted to have like some all like chaotic price of Ethereum to be able to like see how strangle straddles can like capture this volatility. And now we can move to the analysis. I'll let you see, like, give you like 5 seconds
Oh, there's delay.
to.
Sorry, yeah,
Yeah,
I'm the
so there's
DJ here.
weekly and monthly.
Yes, sorry.
Yeah, so you want to start?
No, go ahead. Sorry, I was. I'm trying to anticipate your move and then move forward.
Yeah, so
At some
yeah,
point,
so
I'll
here
read your mind and I'll know. But now I was off a little bit.
so here the strategies they show, like generally when we see it, like the first thing that we see is that they show strong payoff. Like that's the first thing, between 40% to 50%. And another thing that's striking is that when we compare the weekly and the monthly rolling, we see that monthly rebalancing consistently outperforms weekly, and it's almost like twice as much. So, which is pretty interesting. So it just means that less frequent adjustments to capture theta decay more effectively and capture more returns, because you're just letting the price go all over the place without rolling it and then take it back to the current price. So that way is like, it seems that the monthly rolling is just like the best, and also it's even convenient. Like, who wants to stay there and just roll their their position all the time? So you just leave it like once a month, you do it, and that's it, and you wait for the next one. And also, generally speaking, it seems that both strategies, like, they have very minimal performance difference like generally speaking. But then at the end of the backtest, we see that strangles, they outperform straddles, which is not very intuitive, right? Because one, strangles, they are less, they're cheaper than straddles because of the activation of the legs, because it takes a longer time, because we need more price movements to for the payoffs to be for the legs to be activated. So here we have 6.8% for strangle for the weekly, and we have 10.46% for the monthly for the same strategy. Whereas straddle, we are on negative returns for the weekly and a little bit more positive for the monthly, so plus 3%.
Interesting. Yeah, I mean, I think one way to think about this is that if you have a straddle, the two legs are right on top of each other. So you're paying for the put and the call,
Yeah,
two options that you have to buy. If it's offset by a little bit, which is a straddle, then you have maybe solutions where you pay half of it for a while. That's why it's cheaper too. So it's not upfront like regular options, but the Uniswapness of this means that you have maybe less that you have to pay because one leg is out of the money, and the other one is kind of the one that is getting paying a little bit. But yeah,
yeah. All right, we can move to the next one, which the next chart, which gives us more insights. So here we have the composition of premia, payoff, and returns for both weekly and monthly rolling. So we can see that for the strangle, it goes up to 13% almost for the monthly rolling. So it's still more than the straddle here. And another thing that's interesting is that the strangle, when it goes down, when the returns are negative, they're less negative, I would say, than the straddle, which is also a bit interesting. So yeah, at the end of the day, like, it seems that the comparison still shows like some kind of minimal performance differences. Like we're not seeing some like a huge difference, apart from the one thing that's very much different is the returns, like the spikes of returns. So we can see that for straddles it's up to 7%, whereas for strangle it's almost like twice as that. um, do you want to add anything else,
no, this
Guillaume?
is. I mean, the returns are kind of the same as you say, which is a bit
Mm,
surprising. But you just have uh, more occurrence in the monthly. But whenever there's a big spike, a big move, it seems to be kind of the same. So it is like slowly bleeding. If you look on the left, there's a lot of tiny, tiny blue bars, which is how much you pay. And this accumulate, it's mostly negative, but every once in a while you have this big spike on the price move. But whether you're a monthly option or a weekly option, this big spike is the one that prints the most, if you want. So
yeah,
it's just kind of a kind of an interesting kind of trade-off. But yeah, I would say that timing these are a bit difficult, but if you're able to kind of maybe deploy more capital in certain situations, remove the capital and de-risk it a little bit, you can actually now improve on these outcomes because you have maybe on the weekly side, maybe more active need for balancing, but maybe more opportunities to kind of tap into these big moves.
yeah, exactly. Yeah, so all in all, we can move to the next one. So we just witnessed one of, so it seems to be like a more complex strategy, but at the end of the day, it is not, because we've already seen what is a long call, we already seen what is a short put, or a long put or a short call. So we already seen these simple strategies and how they work in terms of, like, in our backtesting, in terms of returns, in terms of like the highest, the maximum gains, the maximum risk that we have. So here in this case, we're just combining two simple strategies together simultaneously. So that's the complexity of it. It's just the fact that we are simultaneously opening these two positions. So all in all, they're both delta strangles and straddles. They're both neutral, delta neutral strategies. And also here we're longing straddles. We're not shorting them. So that's for next time. It would be interesting to see how much fees they're collecting for the short multi-legs strategies. So yeah, in the end, whether you choose straddles or strangles, you're just like essentially making the same bet, which is if ETH will move big and we move fast, or if he moves in your favor, you just remember that in the word of like long volatility strategies, you're not just trading options, but you're also trading chaos itself, especially in the crypto. And so yeah, when chaos delivers, then these multi-legs, they tend to be very much profitable.
And you can imagine on a meme coin or a coin that is
That was something that was say too.
quite volatile, could go up, could go down. It's almost a coin flip. But yeah,
Yeah.
straddles, again, it's called a long volatility. You expect the price action to be explosive, but then without knowing the direction, makes it that you have like maybe a if you're wrong, it's not as it's harder to be wrong. Wrong meaning that it did not move.
Yeah,
If you're
exactly.
definitely on their side at movement, long volatility, then yes,
Yeah,
options like that
especially in
are
the
quite good.
crypto. Yeah,
Yeah,
especially in crypto, where volatility is like kind of a religion there. So yeah.
that's the only thing you can trade. And I think so. One of the things that it's something that we will also have. We have options involved, I guess, in the working, but we can have some of it be automated or at least managed by people. And if you want to be long vol, short vol, bullish, bearish, that's right. You may do it on your own, but there's also ways to kind of offset it to record it. So that's something that's also in the pipeline for the Panoptic team.
Yeah, perfect.
Yep. And I think that was this.
Yeah, so thank you guys for your for being here. And again, if you have any questions, feel free to ask us in our social media platforms, and we'll be happy to answer you and just like spark a conversation. And thank you, Guillaume, for
Perfect.
hosting this.
No, yeah, no problem. And do you know what the next research topic will be for you, or you want to keep it under wraps for now?
Yeah, let's. I mean, I think I'm gonna gatekeep this one for now.
All right. Very cool. So yeah, this was it. So again, this is very interesting. I love that we can have some data backing it, some strategies which
Yeah.
are kind of simple maybe in setup, but then understanding the risk, understanding the rewards is kind of why we do these live streams. So great. So I think that's it for now. Thanks everyone for joining us. And
Thank you, guys.
we'll see you next Tuesday with Nathan on the research team. But otherwise, we have the options hour on Wednesdays. We have the trading show on Friday as well. We'll talk about the competition on base on BTC. Some action there for sure. But yeah, stay tuned. And yeah, I guess